What if I told you there was a restaurant stock that's grown over 350% in the past 5 years? This restaurant is still seeing traffic growth and same store sales growth, while most competitive restaurants are seeing a slowdown. Chipotle is my pick of the week, and today I'll dig into what makes this a great stock. Mexican about to do a 50-to-1 stock split. So this will be a very inexpensive stock later in June 2024, and I would recommend you add this one to your watch list. One of the main reasons that the company is pursuing this stock split is to make the stock affordable for their employees and allow the company to award meaningful stock grants to store managers. Before we move on, let's explain how this stock split works. When the stock splits, its price is just divided by the multiple, in this case 50, and you are left with however many shares you had times 50 at the reduced price. It's kind of like breaking a pencil in half. You're left with two pieces, but they're now half as long. So if it splits at $3,250 and you had one share after the split, you would have 50 shares at $65 a share. Now let's take a look at Chipotle's fundamentals. They just reported first quarter earnings and exceeded analyst expectations. The stock is up almost 10% after reporting earnings. The burrito chain reported revenue of $2.7 billion, which was a growth of 14.1%. Same-store sales growth, which is a key metric in the restaurant industry, rose 7% in the quarter, along with a traffic increase of 5.4%. Compared to some other restaurants, these results are outstanding. McDonald's reported 2% same-store sales growth, and Starbucks reported negative 4% growth. After Starbucks reported, their stock price plummeted 17%. Chipotle expects mid to high single-digit same-store sales growth to continue throughout 2024, even with recent price increases, as consumers still see value in their menu. Chipotle is also operating with an excellent margin in their restaurants. Currently, they are seeing margins of 27.5% compared to most restaurants where margins range from mid-teens to lower 20s. Digital sales represent about 36.5% of sales, which include the high margin. Chipotle's earnings per share in the first quarter was $13.37 versus an expected $11.68. This was an increase of 24% year over year. The average analyst rating on this stock is a buy, with the latest price target of $3,600. My only word of caution on Chipotle is their price to earning ratio is pretty high at just over 69, compared to most S&P companies in the mid-20s. However, this is not unheard of in the industry for a fast-growing restaurant chain. Cava is currently trading at 377 P/E ratio. Chipotle is still growing at a rapid pace. They are planning to build nearly 300 new U.S.-based restaurants this year, and they are starting to expand internationally as well. Their goal is to more than double their revenue in the U.S. At this rate, I expect the stock price to continue to grow in the next few years. So my recommendation is to buy this stock now, if you can afford it, and to take advantage of the split, or buy it post-split for a good growth stock to add to your portfolio. Thanks for watching, and don't forget to subscribe.